Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. Markets have started to creak of late as policymakers are expressing their concerns over the recovery. Fed Chair Powell recently expressed the possibility of using even more policy stimulus if they start seeing long-term impacts on the economy from COVID. With this backdrop, there's been much more speculation about the possibility of negative rates in the US. We've featured some great analysis on this topic on our site this week. Notably, George Gongalves and Dominic Dwarf-Raco write on the Fed's game plan around negative rates policy. We also feature an instructive piece by John Tierney on how to read US and other countries' unemployment data, and I wrote a piece on Asian currencies. Meanwhile, on COVID, we have an Imperial College professor summarize some new work on the impact of COVID on children. And as usual, we track COVID developments around the world in our tracker. We've got some cool new charts to show which countries to focus on. You can get access to all this great content and our Slack channel by becoming a subscriber. It's only the cost of a couple of cappuccinos a week, so it should be good value. On to today's show, we have Juliette Declercq. She runs JDI Research, a leading independent research company. She has an accomplished background with close to 20 years in strategy and trading. Before setting up her independent research company, she worked at J.P. Morgan, Morgan Stanley and Stone Milliner. So on to our conversation. So welcome, Juliette, to our podcast show. I guess the big topic of our time or this year, of course, is COVID, the crisis. And from an analyst perspective or research perspective, the big question is how do you go about analyzing such an extreme, unusual event? And in your research, you've been writing about radical uncertainty and you've thought a lot about this idea of uncertainty and risk and so on. So how have you approached understanding and analyzing this type of market that we're in?
So that's a great question, Bilal, and I'm delighted to speak to you. Market-wise, it's really interesting because at the moment, I've taken to read a little bit more what the macro gurus are talking about. Quite simply also because clients are sending them to me and they're like, what do you think about this? And there's really two schools of thought. It's, the deflationary, depressionary outlook and I guess the, Lassie and Drucker-Miller. And on the other side, you had this really interesting piece from Paul Tudor, which I very much value. And I guess I probably, and I've been talking all week, about both sides and some clients ask me why I disagree with Lassie Hunt and some clients ask me why I disagree with Paul Tudor. And what's really interesting is actually the two schools of thought sort of like converge to say that, whether it's hyperinflation that's going to kill risk or whether it's like depression that's going to kill risk. But it seems like, negativity is very, very pervasive. So that's one point. What I think, and I'll reflect, where I disagree with the deflationary depression outlook is that, things have happened in this crisis that have never happened before. And so, comparing to any of the past recessions for me is a perfect recipe for losing money. I think what really is different this time is like three things. Firstly, we've had central banks basically providing liquidity to governments, but not only on the front end. What normally happens in a recession is you've got the curve steepen. And for me, that's part of the reason why. So first, like effect is basically central banks kills rates, normally like 4%. The curve steepens and you've got the pervasive effect on risk that real interest rates in the long end actually go up. That's not happened this time because, the long end is anchored by the fact that we know from scratch that not only the central bank is cutting rates at the front end, but it's also basically going to be buying more bonds than issued, which has basically pegged the long end as well. That's totally unprecedented. It's never happened before. It means basically, let's call it the public risk premium is basically collapsed and has stayed, near the lows of this cycle, which is one thing. The second thing is central banks this time haven't only have gone further than bailing out governments in terms of liquidity, but also basically providing corporates with bailout. So whether it's in Europe or in US with loan guarantees or direct buying of corporate bonds in the market and going as far as going to junk. High-grade spreads are actually nowhere near where we'd be seeing them at this point of a recession. And that means that looking at PE to value stocks, which is what a lot of those macro gurus are doing, is for me completely wrong, because it doesn't take into account complete change in the macro dynamic. That's what the last piece I wrote about is talking about. And in my opinion, you can basically get through this crisis to a level where you end up with much higher valuation in stocks, which means basically we're not going to get the kind of value that Warren Buffett would be looking for. Basically, central banks have, in a way, underwritten financial conditions, and that's really important thing to take into account. The second thing, which I see is completely different than anything we've seen before, is not MMT. Because I agree that with Lacey Hunt that we haven't gone to MMT. For me, MMT is basically when the government is going to be able to print its own money, and you sort of lose the link with the central bank and the central bank independence, and that can indeed lead to hypervaluation. What we do get is monetization, and whether you call it quasi-monetization, whether the new debt is going to be financed by a really cheap 20-year or even 50-year. I mean, ideally, you would have perpetuals. You'd be financing, those war bonds with perpetuals. But the point is that this time you really have cooperation with fiscal and monetary. And that's also nothing that we have actually seen before. If you look at the last crisis, 2008, 2009, there was massive stigma of the excesses of the past decade. And as soon as we, started to get out of the crisis, it was all about how are we going to repay and basically leading to austerity, or probably led for example, in UK to Brexit, and probably led to Trump in the US. So that's the three things for me that are completely unprecedented. So I'm sort of in the middle in the two school of thoughts. I can see that money is being printed, but I don't think we're losing the central bank independence link, which means that we can get back to, inflation. Potentially, I think, it's a great time for the Fed to finally get back to, overshoot its inflation target. So I'm looking for break-evens to get back to, 1.5, 2 in the next sort of 12 months. But I'm not looking for hyperinflation. And the reason is because what we are seeing is monetization, not MMT.
I think the point you make about equity valuations, I think, is really interesting. And your last report, you talked about this in much more detail. Now, what's the arguments you make to say that equity valuations are not actually too high?
Well, firstly, I never look at PE. I think at this point, they're completely irrelevant, and they're not allowing you to judge valuation over the decades. What I really look at is the equity risk premium, which is basically earnings yield, which is basically the inverse of PE, right? So, and then take away basically real yields. And I use 10-year. And using that metrics, I think at the moment, markets are discounting permanent drop in earnings of 15%. You actually still get, with this estimated earnings, a valuation that is still attractive, thanks to the fact that basically we've seen that 15% drop in earnings yield, which is basically been fully offset by the drop in real yields and corporate spreads, which means that on the equity risk premium level, you're actually still at an attractive level.
So that makes sense. So your argument there is that you need to, one, you kind of have to, rather than look at PE, look at it from an earnings yield perspective, and then you have to take into account the level of yields, bond yields overall. And in that context, then valuations aren't so extreme.
Exactly. And also I think it's sort of normal in a crisis. You see first the explode, and then as earnings start to recover, we will basically get back to more PE levels that will be more attractive to the old school of investing.
And you also made the observation that this is an unusual crisis because bottom-up analysts have revised down their earnings forecasts quite dramatically, and that's not usually the case during slowdowns.
I think that's a key thing as well, is that what we normally see in a recession is that analysts never actually proactively revise earnings. So they look at, the drop in the past quarter, and they basically like go back in line with the drop you've seen. So that creates a sort of like what we call an endogenous recession, where in the end, actually, there is more uncertainty than what we have today. Because what we have today is basically no choice, right? You have to basically take the loss up front. And so we're going to be in a really interesting position where earnings, there's a lot of negativity around earnings, but actually from here, they are going to be revised higher.
Yeah, as soon as we get the reopenings, things will just naturally go up.
Exactly, and if you look at, there's a chart in my report which I find really interesting, and you can see that after the initial rush to downward earnings revision, the net number of companies with a higher price target has actually turned positive again. And I think I looked at it yesterday, we were like at 0 or something. I think that illustrates my point quite well.
And then, the other thing you've talked a lot about is, and again, this kind of goes back to how you need to look at this downturn differently from the 2008 downturn or the 2000 downturn, is how you're looking at labor market indicators and how useful is, say, looking at unemployment numbers, for example. Is that useful or not in this context?
I mean, that's another great point you make. I see, everybody on whether it's on Twitter or LinkedIn, it's like everybody's talking about staggering level of unemployment, unprecedented since 1930s and etc. But the point is in the US and to some extent in the UK, we've never had this level of social security, which, Europe has been used to before. So I mean, I hear now reports of people in the US actually making more money being unemployed than, having lost their job. They actually make more money because of the government grants. So I think the point here, and we don't know what will come out of this phase, but there's two interesting points. The first one is that the ratio of temporary unemployment to permanent unemployment is now 9, which is multiples of anything we've seen before. I think it's basically 80% of the unemployed are unemployed on a temporary basis. That's something that's really important, because if you don't lose the link with your company, you can get out of the recession much faster, and the labor market can be repaired much faster. But the other important thing is that what really drives the economy is income growth. And if you keep the income, in the end, really, the unemployment doesn't matter that much. So what I'm going to be looking at to really gauge the extent and the way we're going to be coming out of that crisis is much more consumer confidence, income expectations. And so far, we haven't got to the lows of the last crisis, which is, given we're basically fiscally stimulating to a much larger level than in the past crisis, to, about 10% of GDP worldwide. I think it's 11.5%. We could actually get out of the crisis in a position that is not as dire as some expect. What I'm trying to say is, obviously, there are going to be losers, and soon we're going to go from the liquidity phase to the solvency phase, and some businesses are going to be insolvent and probably go bust. But what I'm saying really here is the ones that are not going to go bust because they're insolvent, they will come out unscathed potentially.
And in terms of regional differences, I know you have a kind of you have a view on Europe versus the US on the equity side. How do you compare and contrast, say, Europe and the US? You already mentioned some of the labor market differences, for example, but more broadly, how do you map that onto equities?
So the reason I recommended long Euro stocks at the end of March actually was initially because it was it sold off much more than US, and it was the most attractive valuation. Today, I think my kind of view probably would support the tech sector much more, which is much heavier in the US. So I'm a bit more agnostic about things. What I do see in terms of managing the crisis, I think it's all about confidence, consumer confidence. And I can see in Europe, much more of probably better communicated, like definitely better communicated deconfinement. And there's been like big issues. I mean, the whole thing about whether the masks were useful or not, is obviously a big communication issue. But I think we're beyond that now. And I'm following like France and Germany and Italy very closely. I can see a way confidence will start to come back up. And that's a big difference with the UK and the US, where communication, quite frankly, has been a disaster. And I still, obviously I'm in UK and I still struggle to know what I can do. And I still don't understand what the strategy is. The whole phase of like lockdown was supposed to go to like a plan B of basically mass testing, tracing and tracking. And, I still don't see mass testing really. Trump claims that he is mass testing. I'd like to see that. And the same thing for like tracing and tracking. Everybody is sort of like working on those devices and those projects, but it seems that there's still a lot of confusion about how it's going to work. And in UK and the US, the masks are still not a thing, even if it actually seems that it's a very good solution.
Sticking with Europe, obviously there has been, some focus on the periphery in Europe, or say Italy, for example, about European integrity and solidarity, and is there going to be a breakup in Europe? And I guess this kind of goes back to the earlier point you mentioned about all sort of pessimism you have. And I suppose some pre-existing biases of investors have come out during the crisis, where people are looking for a breakup in Europe. Where do you stand in that debate?
I think with Europe, the closer it is to break up, and the faster it's going to get to the next level. I think the German constitutional court last week is a big blow, right? It's like potentially constitutional crisis. Germany doesn't see Europe, I shouldn't say Germany, it's like this particular court, the Constitutional Court, doesn't see the EU treaties as superseding the national court in a way. But I think Merkel was like quite clear yesterday that the way to deal with that is basically with more European integration and more of a political Europe. And I think it is where everybody wants to go. It's just like when you don't get whipped, nothing happens in Europe. So in a way, I'm actually seeing this as people are going to get them together and try and sort this solution, and eventually something better will happen. We shouldn't forget that, Europe wasn't, is still like a project which is being built as we speak, right? So yeah, it sort of like makes me laugh, like when we talk about like a Euro breakup, because, Europe never breaks up, it just moves forward.
So like selling Italian bonds, things like that doesn't make sense to you? No. Okay. Yeah, that makes sense. And then what about euro and the dollar? I know you always have views on the dollar and the euro. How are you seeing things at the moment?
So the dollar for me is a bit like the oil market. It's basically the dichotomy between, what happens in an economy where you're pushing a lot of liquidity, but the economy is actually closed. And, what happens, when the economy actually reopens. And I think we've seen it with oil, last month, and clearly containers got to fill up and everybody got like really bearish oil. We got like negative prices and etc. But the whole thing for me was all about basically, global economy being locked down. So on that, I just want to go back to basically the staggering amount of liquidity that's been pushed by the Fed in the pipeline. And that's actually one point that I haven't really talked about is M2 normally collapses in recession. This time it's actually gone to levels that are like, I'm going to use that word again, like but unprecedented. So what we are seeing is like the Fed monetary base is actually the money multiplier for now is working. And obviously it's on the back of, the Fed. It's about the loan guarantees and et cetera. Like I think banks are actually lending. This is something that is more visible in Europe in terms of like the senior loan survey, which where actually in Europe it's in loosening in standards. In US, you've seen sharp tightening in standards, but I don't see it at all in the credit impulse. So I'm following very closely the bank credit impulse in the US. and we are at like we double the level of the last cycle high. So on the back of like commercial and corporate loan. So the idea that banks are going to get excess reserves but are not going to lend them, it's just simply not true. I think banks are a lot better placed today than they were in the last crisis, and all anecdotal evidence that I'm getting so far are showing that banks are lending and pushing that Fed liquidity towards the real sector. Now, obviously, this is just loans, right? So we'll argue that loans will have to be paid back, as opposed to people that are actually getting grants. But that still goes back to the fact that, if confidence can be sustained and solvent businesses are going to be coming out of this crisis in a good position. And finally, we're going to see that staggering amount of liquidity potentially going to the real economy. And that could be pushing inflation higher, but goods inflation. But my point here is that even if it doesn't push goods inflation higher, which is obviously what we've seen for the past 10 years, and it will still push asset inflation higher. It's like the dichotomy between goods and assets. And in a way, the less inflation you get, the less goods inflation you get, and the more asset inflation you need. And you go back to like the past cycle. And I think, that's still where we are. And the dollar is not going to start reflecting that before the US actually reopens. That's where I wanted to get to. So I'm actually starting to look for setups to recommend like short dollar, but not except versus the euro, where I'm actually short euro. So at the moment, I'm basically recommending like short euro, short dollar Korea, but actually long gold. So it's a bit of a mixed bag, but that's the way I'm thinking about the dollar right now.
And the long gold, presumably that's a reflection of all of this excess liquidity being injected into the system.
Yeah, it's more like a reflation belief. I see gold as a reflection of real yields. So I'm going to be completely wrong on gold if we end up in a deflationary monetary trap, which would happen if we basically get like second waves that make us go back to full confinement.
And the caution around the euro itself, what's that related to?
Actually, the short euro is not really caution about Europe. For me, I see the euro, I saw it before when states were not able to print their own money as the perfect longs versus for example, the dollar, where the central banks is able to debase the currency by printing money. But I think things have changed since Mrs. Lagarde sort of like whatever it cost. And the way I see things now is like whatever Germany is seeing is that Italy can print money. And basically Lagarde has been quite clear that spreads is something that they will be looking at, and that tight spreads is their mandate. And therefore, for me, the whole thinking about like if you're in a monetary union, you can't use the printing machine is gone, which really like takes me back to my last report, which was called La Casa de Papel, where, suddenly everything opens up.
La Casa de Papel, just for our listeners, that's called Money Heist in English. It's the name of a very popular Netflix show at the moment, which I'm a big fan of, I have to say. And if you kind of step back a bit, I mean, what do you think are some of the longer term consequences of this crisis, the shutdown, the reopening? I mean, what do you think is going to be sort of different going forward?
I mean, I guess there's what might happen and there's hope, right? So what I'm hoping for, because I think, it's very difficult to know what will happen at this stage. But what I'm certainly hoping for is better global governance. I think this crisis has shown us very clearly that looking at your own state is not going to be benefiting even yourself. And I think that's quite clear in the US right now. I think Donald Trump has tried for the last 4 years to make America great again. But the last 2-3 months have shown us that America is not going to be great again in absence of Europe being great again. I think we need a lot more cohesion, at least in the Western world. And I'm hoping that we will get there. that I think both sides are going to realize that we can do a lot better together than just trying different things and basically stealing from neighbors. So maybe get back to the sort of like better global governance that we had before the last crisis. And otherwise, that's hope again, but probably more social and climate. If you look in Europe, we're all about like reshoring and much more about social and climate. And I think UK, once we get past the whole Brexit frenzy, is probably going to go the same way as well. And I guess probably the biggest question mark right now is the US, because I don't think Europe, UK are going to go anywhere without the US, sort of leading the charge there. And that takes us to the US election, obviously.
And do you have a view on the US election, on the outcome of the election, but also the market implication of either of the outcomes?
At this point, I don't really have a strong view, and I don't really have views that I want to air on. So I'll make the best of whatever happens. And I think the world has changed so much in the past 2-3 months that you can't even really say with any certitude how, winning Trump might be completely different than, the Trump of the last 4 years. I think it's extremely difficult to read, even like the interaction with China and et cetera. I mean, Europe is also really pissed off at China. Right. The way I'm thinking things could happen in terms of trade deals and export imports is, and I can't remember who was who mentioned it in France, but having a point-based tariff where basically you look at the points of whatever company, whatever export imports, what the point-based barem would be for climate, social, and then use this to basically apply a tariff. And I think that could be a really interesting way to move forward and put pressure on countries that are not quite there in terms of the new level of climate and social consciousness that we want in the world, without creating too much a new trade war.
And on the social and climate governance, in your eyes, does that have any consequences for equity markets or not?
I think it's like a whole world of new opportunities. I can't remember which country actually came out with, instead of GDP, they're going to be looking at a different aggregate to see whether, progress is being made. And I think we can all agree that, GDP growth has sort of run its course, right? I mean, we're still kind of looking at continuous growth, and I've called this like a Ponzi scheme for many years now. You just can't grow infinitely. So I think, that's one way we could go as well is, of course, we don't want to degrow. You don't want to be exposed. But I think we could do really well with a low level of growth and a lot of progress on all sort of other things that are really important for the majority of people.
Yep, that makes sense. And actually, one thing I always ask all the guests is, what's the best way for people to be able to reach out to you and to follow your thoughts?
So unfortunately, the best way to follow my thought is really to become a client of JDI Research. All details, you can email me at juliette.declercq@jdiresearch.com. Occasionally give interviews, and I think that's the first one we actually do, Bila. Only to nice people.
Okay. Yeah, so with that, so thank you very much, Juliette, and good luck with everything.
Yeah, well, thank you.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.